You wake up in the morning. You check your phone. Nothing feels different. But while you slept, trillions of dollars were created, promised, rolled over, and quietly pushed into the future. Not printed. Not earned. Promised. And almost all of it was debt. Here's the uncomfortable truth most people never hear clearly. Modern economies don't run on money. They run on debt. Not as a side effect. Not as a temporary fix. As the foundation. If debt suddenly disappeared, the global economy wouldn't slow down. It would stop. Right now. And once you see why, you can unsee it. This matters now because every major economy on Earth is carrying debt levels that would have sounded insane just a generation ago. Governments. Corporations. Households. Banks. Even pension systems. We're told it's normal. We're told it's manageable. We're told it's different this time. But no one explains the actual mechanism in plain language. So let's do that. No jargon. No lectures. Just how this system actually works. Start with a simple question. Where does money come from? Most people imagine something physical. Printing presses. Government vaults. Some authority creating money and releasing it into the world. That image is outdated. In modern economies, most money is created when someone goes into debt. Not metaphorically. Literally. When a bank gives a loan, it does not hand out existing money. It creates new money by typing numbers into an account. That money exists because someone promised to pay it back later. No debt. No new money. This is not controversial. This is how the system is designed. Which means the money you use every day is inseparable from debt. Your paycheck. Your rent payment. Your groceries. Your investments. All tied to someone, somewhere, owing something. Now zoom out. Governments do the same thing, just at a larger scale. When a government spends more than it collects in taxes, it borrows. It issues debt. Bonds. Promises. Those promises become assets for investors. Banks. Pension funds. Insurance companies. Central banks. Government debt is not a failure of the system. It is the system. Because that debt is what allows money to exist at scale without immediate taxation. Here's the irony. The safest assets in the world are debts. U.S. Treasury bonds. Government bonds. Sovereign debt. The global financial system treats them as the foundation of safety. As collateral. As reserves. So when people say, "We're drowning in debt," they're also saying, "We're drowning in the very thing holding the system together." That's the paradox. Now let's slow this down and make it concrete. Imagine an economy with no debt. No loans. No bonds. No credit. Every dollar must already exist before it's spent. That means no mortgages. No business expansion without savings. No government stimulus during crises. No large-scale infrastructure unless taxes are raised immediately. Growth becomes painfully slow. Innovation stalls. Risk-taking collapses. Because debt is not just borrowing. It's time travel. Debt allows future income to be used today. That's why economies embraced it. Debt smooths consumption. It spreads costs across generations. It allows large projects to happen now instead of never. A bridge. A power grid. A university. A pandemic response. Without debt, those either don't happen or happen too late. So debt became normal. Then necessary. Then invisible. And that's where things get dangerous. Because once debt becomes the backbone, the entire structure must keep growing. Here's the uncomfortable math. Debt carries interest. Which means the total amount owed is always larger than the amount originally created. To pay yesterday's debt, tomorrow's economy must be larger. Not slightly larger. Consistently larger. This is why growth is not optional in modern economies. Stagnation is not neutral. It's fatal. When growth slows, debt becomes heavier. Defaults rise. Systems strain. Governments panic. That's why recessions feel so dramatic. They're not just about unemployment or falling markets. They're about the system briefly realizing it promised more future income than the future can comfortably deliver. Now here's where the story gets more unsettling. Governments don't just tolerate debt. They depend on it. Why? Because debt is politically easier than taxes. Raising taxes is visible, immediate, painful. Borrowing spreads the cost across time and voters who don't exist yet. Debt delays accountability. And because the economy grows over time, the hope is that future income will make today's borrowing feel smaller. Sometimes it works. Sometimes it doesn't. But the incentive structure is clear. Borrow now. Explain later. Now add central banks. Central banks don't directly control governments. But they control the environment debt lives in. Interest rates. When rates are low, debt feels light. Manageable. Almost free. When rates rise, debt suddenly becomes heavy. Restrictive. Dangerous. The same amount of debt can feel harmless or catastrophic depending on rates. That's why central banks are obsessed with stability. They're not just managing inflation or employment. They're managing the weight of debt across the entire economy. Raise rates too fast, and debt snaps. Keep rates too low for too long, and debt balloons. There is no painless option. Only trade-offs. Now zoom out further. Corporations. Most large companies do not operate primarily with their own money. They borrow. They issue bonds. They refinance old debt with new debt. Debt fuels expansion. Buybacks. Mergers. Acquisitions. It boosts returns when things go well. And magnifies damage when they don't. Households. Mortgages. Student loans. Auto loans. Credit cards. Entire life paths are structured around future income being pledged in advance. This is sold as opportunity. And it is. But it also means personal financial stability is increasingly sensitive to interest rates, job markets, and macroeconomic forces individuals cannot control. Now here's a quiet truth rarely stated plainly. The system does not expect all debt to be paid back. It expects debt to be rolled over, replaced, refinanced, extended. Old debt is paid with new debt. This is not fraud. It's design. As long as confidence remains, the machine keeps running. When confidence breaks, everything freezes. That's why financial crises are so sudden. Not because debt suddenly appears, but because trust disappears. In 2008, the problem wasn't just bad loans. It was the realization that too many promises depended on future income that wasn't going to arrive as expected. The gears locked. Credit markets froze. And without credit, the economy couldn't breathe. So governments stepped in. Not out of generosity. Out of necessity. They borrowed more to stabilize a system built on borrowing. Debt saved a debt-based system. Absurd. And yet effective. Now fast forward to today. Debt levels are higher than ever. Public debt. Private debt. Global debt. The numbers are almost meaningless at this scale. What matters is structure. As long as growth continues, debt can be serviced. As long as interest rates stay manageable, debt feels stable. As long as people believe future income will exist, debt remains invisible. But this balance is delicate. Small shifts matter. A rate hike here. A slowdown there. A demographic change. A geopolitical shock. Debt doesn't cause collapse by itself. It amplifies everything else. Now here's the part most discussions avoid. Debt shapes power. Creditors have leverage. Debtors have constraints. At a national level, this influences global relationships. At a corporate level, it shapes strategy. At a personal level, it shapes life choices. What job you take. Where you live. How much risk you can afford. Debt is not neutral. It quietly directs behavior. And because it's normalized, its influence feels invisible. Now contrast the story we're told with reality. We're told debt is like a household budget. You borrow too much, you tighten your belt. But nations are not households. They issue the currency their debt is denominated in. They can roll it indefinitely as long as confidence holds. The real limit is not money. It's trust. Trust that future production will exist. Trust that inflation won't spiral. Trust that political systems won't fracture. When trust erodes, the math suddenly matters. That's why inflation is so dangerous in a debt-based system. Inflation erodes debt in real terms. Which sounds good for borrowers. But it also erodes trust. And once trust goes, interest rates rise, debt becomes heavier, and the system tightens violently. This is the knife-edge modern economies walk. Now zoom out one last time. Debt allowed unprecedented growth. It funded innovation, infrastructure, education, global trade. Living standards rose. But it also locked the system into perpetual expansion. There is no steady state. There is no pause. There is only forward motion or stress. This doesn't mean collapse is inevitable. But it does mean the system is fragile in specific ways. It depends on coordination, stability, expectations, and it depends on future generations honoring promises they did not make. That's the moral tension at the core of debt-based economies. We enjoy the benefits now. The costs arrive later. Sometimes much later. So here's the unresolved question. If debt is the backbone of modern economies, what happens when growth slows permanently? Not a recession. Not a cycle. But a world with aging populations, climate constraints, and slower productivity gains. Can a system built on future promises adapt to a future that looks smaller? Or does it demand growth even when growth becomes harder to find? That question has no clean answer. But the way we respond to it will shape the next era of the global economy. Quietly. Slowly. And then all at once.